Okay, you guys, we're now going to take a look at Chapter 10, which goes into more detail with current liabilities and payroll. Now, as far as current liabilities go, the main one we've dealt with in this course is accounts payable. Now, remember, it ends up on the books when we purchase goods or services from another business and promise to pay them for those goods or services in the very near future, usually 30 to 60 days, and there's no interest charge involved. It's making a purchase of goods or services on credit. Another common, and we've gone through about everything we can with accounts payable. There's not a lot more to do with it. They also mentioned notes payable. Well, in Chapter 8, we went through notes receivable, where we were the lender. With notes payable, we would just be the borrower, and the due date on the notes and the interest due at maturity on the notes would be calculated the same way that you've seen interest calculated back in Chapter 8 on notes receivable. It's just the other side of it, and you can certainly see those journal entries here in Chapter 10. But I thought what we would look at for our problem from Chapter 10 is a payroll. And now this is a very simple, straightforward payroll. But the reason payroll is grouped in this chapter is anything that the employer withholds from the employee's check. It doesn't belong to the employer. The employer immediately owes that to some third party, be it the federal government, the state government, maybe an insurance company. So any withholdings from employees' checks create a current liability for the employer. Remember, the definition of a current liability is one that we will pay out of current assets within 1 year or less. Well, anything withheld from employees' checks has to be forwarded on to the federal or state government or the appropriate parties very quickly. So you guys, I think you're going to find we're going to make two journal entries here. One to record the payroll itself, and then one to record the employer's share of payroll taxes. And I think after a little practice, you'll find these journal entries to be fairly simple, because the first one at least kind of mirrors a pay stub. Now let's think about what all is withheld from a paycheck. You know, I'm sure all of you have received one before. On that pay stub, you've got a number over on the left-hand side called gross pay. Then you've got a number over on the right-hand side called net pay, a much smaller number, unfortunately. Or fortunately, depending on how you look at it, I guess. Okay, the withholdings would be the difference in the two. Now, withholdings could be one that you would have anywhere in the United States would be federal income tax. It's withheld from the employee's checks. The employer does not have to match it. The employer would have to pay federal income tax, but it'd be based on their profit or taxable income, not based on payroll. And you guys know how that works. They withhold it from your checks, or an employer withholds it from employees' checks, and then at the end of the year, the employee files a personal tax return. They compare what they owe to what was withheld from their checks. If what was withheld is more than what they owe for the year, they get a refund. If what was withheld is less than what they owe for the year, then they'll have to pay additional taxes with their return. State income taxes work the same way. They're withheld from your check as the year goes by. Then at the end of the year, the employee, by the employer, and the employer sends them in to the state. Then at the end of the year, the employee files a personal state tax return. They compare what was withheld to what they owe for the year. If the withholdings are greater, then there's a refund. If the taxes owed are greater than the withholdings, then the employee has to pay more income taxes with their state tax return. Now, not all states have state income tax. North Carolina does. Tennessee, for example, does not. What else? You could also see what we call FICA taxes, which stands for, that's an acronym, it stands for Federal Insurance Contributions Act. Those are New Deal or FDR programs, or I guess Medicare came actually under Lyndon Johnson, but considered to be a part of the New Deal. Social Security and Medicare are your two parts of the FICA taxes. Social Security is withheld from the employee's checks at a rate of 6.2%, and that's limited to around the first $113,000 each employee makes per year. So you pay the employees, would withhold from their checks 6.2% until they hit that Social Security limit of, I believe it's around $113,000. Any amounts made above the $113,000 are not subject to Social Security tax. Medicare tax is 1.45% withheld from the employee's checks, and that's withheld on every dollar you make, whether you make $10,000 or $10 million. No limit on Medicare. Now, the FICA taxes or Medicare or Social Security, one way that they're different from state and federal income taxes, not only are they withheld from the employee's checks at a total of 7.65%, that amount also has to be matched by the employer, dollar for dollar. Okay? So if you happen to be self-employed and you're the employer and the employee, you have to pay both halves. That's referred to as self-employment tax, and that amounts to 15.3% of your pay for the year. What else is withheld? Well, you could see insurance withholdings. Now that could partially be paid by the employer, could be completely paid by the, could be partially paid by the employee, could be completely paid by the employer, in which case it would not be a withholding, or it could be completely paid by the employee, in which case all the cost of the insurance would be withheld. Any part paid by the employer, though, is not a payroll tax for them. Instead, that's just part of their compensation expense to the employee. You could see any type of savings program, Christmas account, or just any retirement account, any type of savings program. Retirement, you could see defined benefit plan. That's your traditional pension plan where you work so many years and then you can retire at a percentage of your salary. Or you could also see a defined contribution plan, which is more common nowadays. It's also referred to as a 401k plan, where you make contributions, maybe your employer makes contributions, and then what you contribute is always yours. Usually you have to be with a company for a certain period of time to vest, so that employer contributions to your 401k belong to you as well when you separate from employment, be it for retirement or some other reason. You could also see garnishments, which would be a court-ordered withholding. You could also see maybe some type of charitable donation. United Way is a common one there. So what we would do is take gross pay minus all those withholdings, and we'd come to net pay, what the employee actually receives on their check. And what we're going to do in this first journal entry, we're going to record the salaries as an expense at gross pay. We'll record the withholdings as liabilities, current liabilities, at the withholding amount. And then the difference in gross pay and withholdings will record as salaries or wages payable. In our problem, it'll be salaries payable for the net amount. So it's kind of like a company-wide pay stub, if you will. Now, I mentioned the difference. With salaries, are usually paid by the year. With wages, we call it that when the employee's paid by the hour. Okay, you guys, we didn't really get to any of the problem in this video. We should call this, I'll call this one the Chapter 10 lecture video. But we'll start with problem 10-2A on page 488 and 489 in the next video. Thanks.